Welcome to Finders Keepers, the vodcast powered by Asset Find. Here, we talk with the people shaping the future of global financial asset recovery, from industry veterans to technology innovators. Each episode uncovers new insights, real-world challenges, and the emerging tools helping companies locate and recover billions in unclaimed financial assets worldwide. If it touches finance, data, or discovery, we're talking about it here. This is Finders Keepers, where every conversation uncovers something worth finding. Well, welcome everyone to today's episode of Finders Keepers. And the title of today's episode is Unclaimed Property Compliance, the Risk That Nobody Sees Coming. Our guest today is Samantha Petersen. Samantha has spent over 30 years mastering one of the most overlooked yet surprisingly high stakes corners of finance, unclaimed property. She's a certified fraud examiner, founder of the Petersen Group, and she is the woman that Fortune 500 companies call when the government comes knocking for money they forgot they owed. Samantha is a true pioneer in her field and a former KPMG practice leader. After 3 decades working at the highest levels, she brings a depth of experience that is hard to match. Great to have you with us, Samantha.
Yeah, thanks, Sean. Thanks for having me. This is exciting, and I can't wait to answer some questions about unclaimed property.
Well, we know that you have such a rich and depth experience, and so we are looking forward to hearing all your perspectives. So,
Sure.
first of all, I would say, what is the single biggest myth that companies believe about unclaimed property compliance, and why does it hurt them?
Gosh, yeah, that's a great question. So, doing this as long as I have, I've heard so many, companies and their management make the comment that, oh, we don't have unclaimed property. We don't have any outstanding checks or AR credit balances on our books. And come to find out, it's because they don't understand that it's been company practice to write those transactions off to income or reverse the expenses. So it's not on the books, but it doesn't mean that there's not an unclaimed property exposure or liability there. And this hurts the company because, again, that's a financial statement impact that a controller or someone, a CFO level person may not be aware is hidden within the financial statements. And this is especially concerning for publicly traded companies, simply because, again, through publication of their financial statements through the SEC and the various accounting rules and requirements, this could lead to what we refer to as an ASC 450 issue, where a company may have a hidden loss, and under those loss contingency rules, have an obligation to either disclose that in the financial statements and/or estimate that loss. So again, that could be a significant financial statement impact, what we call a P&L impact, that the company's just not aware of. And we do see that quite often when there's M&A activity with a company, simply because a company looking to acquire a target company, neither one of them are aware of the unclaimed property risks. Again, you could have those hidden exposures not just in your own books and records, but the books and records that a company could be acquiring as part of an M&A deal.
It makes a lot of sense, and especially, of course, even more complex when we're talking about mergers and acquisitions. But again, something that people need to take a much closer look at. And, what would you say, in your experience, is the most common compliance mistake that you've seen even the most seasoned finance teams even make?
Oh yeah, that's easy. It's usually the use of a NAPA standard code. So the states use a standardized code where they may not be consistent across all states. The NAPA standards are there, but not every state adheres to that. So trying to translate to the best of their ability, well, what is the closest code that I should be using? Because each of those codes have what's called a dormancy period associated with them. A perfect example, I see this one often, is a company may be using the code CK13, which again stands for an uncashed check. So CK13 seems to be the logical option. But if it really is the underlying transaction was a payroll or a wage check, the company really should be using an MS miscellaneous type code, which has a 1-year dormancy, as opposed to a 3 or 5 or even sometimes longer dormancy period, depending on the codes that they're using. So, and even seasoned professionals like myself, sometimes we're limited by the records that a company provides to us. So oftentimes what I see is, yeah, I would love to have a last activity date. On a check, it's easy. It's the check date. When did you cut the check? But sometimes, maybe that's not really the activity that or the date that we want to use to trigger that dormancy. It could be that last activity with the employee, the vendor, or the customer. So in those cases, sometimes those dates are just not there. And we're forced to use the best available data, which sometimes is not, the best answer, especially for the company. So I would say again, it comes down to those property codes, making sure that you're triggering the dormancy based upon a proper last activity date. And that last activity date can be subjective. It really is whatever date the company chooses to use as that dormancy trigger. And I always tell companies, when they ask me, well, Samantha, what's your recommendation? What would you do if you were looking at the data that we do have? I would say, look, make your best decision based upon, the data that you do have. And if you're going to be wrong, just be consistently wrong. There's nothing wrong with that. I mean, there's no right or wrong answer sometime in unclaimed property, but it is, can you justify the decisions that you've made? And does it make sense? I mean, are you adhering to the underlying principles of unclaimed property, which is trying to get this money back to the rightful owner? And if you can't, you've truly lost that contact, then you give it to the state, right? So it's making sure that you've done all of those things in between before it becomes reportable to the state.
So it sounds like it's a lot more nuanced than one might think. That's one theme. And that there's a real need to be both consistent, as you said, and an attention to detail is
Mhm.
critical to sort of
Right.
stay ahead of this. So in the last, over the years, how would you say that the reporting of unclaimed property has evolved, I would say in the last decade? And what's
Mhm.
been the biggest disruption that you've seen?
Wow, well, that's a great question. Well, I've been doing unclaimed property for a long time. Believe it or not, over 30 years now, pretty much dedicated. I've grown up in this world of unclaimed property. I graduated college and walked right into my first job, unbeknownst to me, into an unclaimed property audit that was ongoing for the company that I was working with. So I
Wow.
was kind of
Sounds like
thrown
fun.
in.
Sounds like fun.
Right, right. No, I was thrown in feet first. Back in those days, we really were trying to learn right alongside the states and their auditors. A lot of this was very new and subjective, and not everybody understood it, including the states. It was their law, but even they didn't quite understand how these apply in a practical world, or how do you audit for it. Like I said, just watching, state and local tax auditors, or God forbid, a sales and use tax auditor try to come in and conduct an unclaimed property audit. It was quite interesting, growing up in that environment. But I have seen this whole industry involved. The practice around unclaimed property has come a long way. I can tell you when I first started, not to age myself too much, but again, right out of college, was thrown into unclaimed property of the Fortune 500 company that I was working with. And I remember having to print the state forms out of a book and sit behind a typewriter and literally type up my state unclaimed property reports. That, there was no electronic online submission of anything. It really was, you printed up forms, you mailed them to the state along with the check. And that was quite time consuming. And like I said, I was with a Fortune 500 company that had quite, a number of properties that had to be reported. So sitting behind that typewriter was not fun, and it was not, efficient. So, watching the technology evolve in this space has been, a huge, huge issue. But, the other thing I would say is that, one of the most disruptive changes in that whole experience has been when consultants like myself left and actually started working and conducting contingent fee audits on behalf of the states. So these were people that, just like myself, had been working to defend companies, understood, the arguments and the defenses and the strategies to minimize those exposures, actually started their own audit firms now working on a contingency fee for the states. So these audits quickly evolved, and I can say, again, in my experience, that was probably the most disruptive, because we saw not only these aggressive contentious audits, but just the states, multi-states now, you now compounded audit complexities, because I'm not just dealing with one or two states, it's pretty much every state. And I would say that those kinds of audits back in the day led to a lot of litigation.
It sounds like a bit of a chaotic time. Um,
Yeah.
but I guess again, as you say, that's part of the learning, and it's brought you to where you are today.
Right.
And so, it's often difficult to sort of get this topic to have enough weight for your sort of average CFO. And so,
Right.
if you had sort of 60 seconds for the CFO to actually convince their board that
Mhm.
unclaimed property matters, what would the pitch be?
Oh, I always tell my clients, and I do get asked that question quite a bit. Samantha, I'd love to get this stuff cleaned up, but it's just not on anybody's radar, and I can't really get anybody to get behind it and understand it the way that it needs, to be addressed. So I just, my pitch to any C-level person, much less, a C-level person going to a board to ask for approvals or budgets or, just to emphasize, the need. I would just say if minimizing risk and protecting your brand matters to this company, then we need to acknowledge that unclaimed property is a regulatory liability that these states aggressively enforce. So unclaimed property is not a tax, but it needs to be given that same level of compliance importance. It's the law, and there are some heavy penalties and interest for noncompliance. So I always tell companies, look, that's really what it boils down to. It's the law. You have an obligation to comply. So doing it to the best of your ability to minimize that risk and to protect your brand. Because if you don't, there are some areas where companies can really get sideways with these states. And worse yet, some of these unclaimed property laws kind of go hand in hand with consumer protection. I kind of look at gift cards and, some other, properties where now all of a sudden it's not just unclaimed property. It's like, unclaimed property compounded with, consumer protection. Like gift certificates are a perfect example. The states have certain requirements in terms of how they're marketed, how they're branded and packaged. But, again, if they're not redeemed, what are the rules? Because not every state follows the same exemption or, the allowance deductions and, basically your breakage on those gift cards to be taken into income. So it does need to be scrutinized and looked at closely. Otherwise, getting sideways, not only with unclaimed property, but now consumer protection can lead to class action lawsuits or just brand reputation damage. I mean, so
Right.
companies need to be aware of that.
So it's not just a financial, issue. It is potentially liability, and to your point, reputational damage. And I would
Right,
say even more important for those public companies. Really,
right,
it could be a
right,
real hit to
right.
their reputation. So knowing all of that, what are some of the sort of early warning signs that a company may be heading toward an unclaimed property audit?
Yeah, I would say the most common is going to be not reporting at all. The states have gotten very sophisticated in comparing their other tax and business licensing, compliance. People that are, companies that are submitting, those types of taxes or, have those types of business licenses to see if they're complying or reporting unclaimed property. And if they're not, chances are they're eventually going to get an audit notice.
Right.
Other things could be, even for companies that are in compliance, it's, the states are getting again more savvy and looking at, well, what is a common, reporting for this industry? What does that look like? And does this company include all of the property types that we would expect to see? I see it all the time where companies may report, payroll and some accounts payable checks, but never reported AR credit balances, never reported some of these other general ledger property types that sure enough, when an auditor comes knocking, first thing they do is look at the general ledger and all of those activities and going, well, what about this? What about that? And why aren't you reporting it? Right.
And
So I see,
if
yeah.
they're not reporting it, Samantha, is it generally lack of knowledge
Mhm.
of the process, or is it perhaps just don't have time and it shouldn't be too much of an issue? A combination of both. Where do you see the issue?
Yeah, I think it's just lack of understanding and knowledge. There's just not as much training around unclaimed property compliance as you would see in other tax areas or other accounting rules and requirements. There's still that. I mean, I would say it's not as bad as it used to be, but there's still this underlying level of just misunderstanding. And it kind of goes back to what we said at the top of the call today was that most companies just don't think they have unclaimed property because there's nothing on the books.
Right.
But they don't realize that the established practices that may have been in place for years, if not decades, are what lead to the unclaimed property risks and exposures that we're talking about. Because, hey, we don't have anything. So it just, the can just keeps getting kicked down the road. Nobody ever takes it seriously unless someone who comes into that company has experienced an unclaimed property audit, has, some knowledge, some basic understanding of unclaimed property, says, hey, wait a minute, we need to rethink this, and we need to rethink what we're doing in daily processes to make sure that we're not writing this stuff off, that we are properly journalizing it, transferring it to unclaimed property liability accounts, or whatever is deemed appropriate, so that we can say that we are in compliance with state unclaimed property law.
So the two letters of the alphabet that are probably the most used in the last maybe 2 years and probably going forward are, of course, AI together.
Mm-hmm.
AI is really, it's reshaping every corner, of finance.
Mm-hmm.
So, where would you see, or where do you see AI making the most meaningful impact in unclaimed property over, say, the next few years?
Oh, yeah, I see it definitely being a disproportionately large impact on unclaimed property, because the reason is simple. I just think that unclaimed property is where unclaimed property intersects with large databases and multi-state regulatory complexities. So again, trying to marry up large, volumes of data with these state rules. Again, a lot of that can be integrated into AI technologies and AI tools. Some of the things that we're doing here at the Petersen Group is just that. Not having human eyes on some things, especially when they're what I call repetitive manual processes. Again, if you have a certain interpretation of a state law, that can be built into an AI model that basically you train the AI to say, no, we're this is the interpretation, this is what it means, this is how it's going to be applied. And you can kind of lay those foundations and boundaries around that kind of decision making. So when we get client data, like I said, sometimes it's just raw data, and there's always a story in the data. So we're using AI to help tell that story and to extract the data that we need to tell the right story, or what we believe to be the right story, that the company has unclaimed property or not, based upon what we're seeing in that data. Can we justify that it is or is not unclaimed property? And based on that, the company can make better decisions, because, like I said, data tells a story. What does our data tell us? So again, I see that's probably one of the most integral parts of where AI has been not only helpful to us already, but I can just see that's just the future. It really is, not just in unclaimed property, but in a lot of respects.
Yeah, I would agree, and I think that we've sort of just only scratched the surface, and there's so many more areas and corners that we can go to leverage this. And so, if we go back again to talk about M&A, so
Mhm.
for businesses that are going through mergers and acquisitions, what is the one unclaimed property issue that you would say is often overlooked until it's too late?
Yeah, I would say it comes down to one term that we refer to as successor liability. We see this quite often when a target company has not been in compliance. Goes back to nobody understood unclaimed property, so there's never been a reporting history. So what happens is, even though a target company is being acquired and that liability is there, the onus is really on the buyer. And they have to make sure they understand, or they have at least looked at unclaimed property exposures. One, because is the company that you're buying overvalued, overstated, because they've been taking things into income that again impacted those financial statements over the last 10 years. And what happens is, now after the buyer is now part or merged into the target company is now merged into the target company. Now all of a sudden the target company, their liabilities are sitting with the buyer, and the state comes knocking, that liability is going to have to be settled up sometime in the future. So during that M&A deal is, our companies looking to make sure that they properly valued these companies, made purchase price adjustments for those kind of exposures within, the purchase agreement. I've even seen situations where companies have set aside escrows, so that if that liability is going to stay with the seller, the target company, and those particular liabilities are excluded from a purchase agreement. Again, it has to be very specific. Those purchase agreements have to be very specific. And I would say that one of the other areas that always gets companies kind of sideways is that they just assume that a general tax provision within those purchase agreements are going to protect them. But remember, unclaimed property is not a tax. So unless unclaimed property is specifically addressed and is included or somehow addressed within the assets and or the liabilities that are coming over as part of that M&A deal, again, it the states will assume you acquired successor liability, and now the burden of proof is on you to prove that that liability stayed with the seller and you didn't acquire it. And I'll give you a perfect example, Sean. This we see this a lot. Companies will say, but it was an asset deal. We didn't buy any, we didn't buy the stock or any of that. But you bought accounts receivables or you bought, bank accounts, right? So unless we're talking physical assets, buildings, equipment, that kind of stuff, within those general ledger assets, you could have hidden liabilities because the balances that came over in your accounts receivable agings, those could be exposure. So again, it's always important to make sure you understand where these little risks are hidden and make sure those are addressed as part of that M&A deal.
So it sounds like it, when there's, the checklist of due diligence that, unclaimed property has got to be up
Mhm.
there as, one of the top aspects
Mhm.
and check marks as any other part of, strict due diligence, because there could be some very, very unpleasant surprises on the other end of the deal.
Absolutely. Absolutely.
So let's say that there isn't compliance, and unfortunately, there's a the business leaders can get audited, and of
Mhm.
course they dread it. So they get audited or get a VDA letter. What is the best first step that you suggest when a CFO has one land on his or her desk?
Yeah, and again, this happens every day, right? So I would just say, obviously, I recommend that companies be mindful of deadlines and instructions set forth in the letters, but don't respond immediately. I have seen the biggest issue is a CFO says, we don't have unclaimed property, therefore, I'm going to fire this letter back to this company or this audit firm and go, hey, go pound sand somewhere else because we don't have any exposure. Well, that's usually the first red flag that there is exposure, right?
Right.
So I would just say, look, when you get the letter, like I said, be mindful of those deadlines, be mindful of the instructions, but first, assess your exposure. Responding too quickly, again, that knee-jerk reaction, can make things even worse, right? Because now you're trying to backpedal or undo or unwind something that may have been communicated to the state or their auditors, or God forbid, information has now been provided that you didn't quite understand what an auditor was going to use that information for. So now all of a sudden you may have opened Pandora's box thinking that you were doing the right thing by telling the state, hey, we don't have anything. But unfortunately, doing that without really assessing the exposure and understanding the risks can get a company in a lot of trouble.
So they can essentially dig themselves deeper if they, again, don't take this seriously, and,
Yep.
you know, perhaps recognize that they just weren't taking all the precautions they needed to. And so,
Correct.
take that pause, take a deep breath, and make sure that if it was not done correctly in the past, that this is the
Mhm.
time not too late to reset. Of course, prevention is
Right.
always better, but when you're in this situation, all you have to do is the best that you can do with what you have.
Exactly.
So we've talked about some of the things that don't work. But
Mhm.
what's a compliance practice that you actually see is working surprisingly well across specifically highly regulated industries?
Oh, yeah, that's a great question. I would say probably treating unclaimed property as more of a quarterly financial control than looking at it as an annual filing obligation, right? So, companies, treat unclaimed properties like this once a year reporting task. And, we have to go through our records, oh my gosh, now, we're 2 weeks away from the deadline. It's usually a rushed process, and people are asking, what do we need to report to the states this year, right? So I would say, looking at that from a little bit different perspective and just asking, maybe asking the questions more in the line of, hey, do we have dormant accounts? Why do we have dormant accounts? And what should we be doing in order to, minimize that and not have as much throughout the year, so that when we do get to this point where we do have to submit that annual filing, we've been taking care of that process all along. It's not just something that we do once a year right before a deadline. We have built that into our processes. And that's why I say, kind of going back to that quarterly financial control, making that part of your daily routines. And the goal really should be to identify those issues early and not wait until those state dormancy periods have told. Because remember, now you're looking at things that are a year, 3, 5 years old, when it could have been better addressed, immediately, within a couple of months, or within a check going uncashed or an AR credit balance on the account. So again, making sure that the company understands that if you have what I call automated or, standard processes of just writing that stuff off without reviewing it, you may want to rethink those processes and look at that more from that quality financial control initiative, so that again, it's part of your daily routine.
I like the word routine that you use consistently in your answer, because I was thinking of an analogy when you sort of said the
Mhm.
best thing is those companies that are looking at it from a quarterly perspective and not just waiting until the 11th hour. I sort of see it
Right.
from, we can sort of, it can be analogous to sort of health. If you have great routines with respect to your physical activity and, your food, when you go to the doctor, you're not panicked.
Right.
You don't have to panic at the last minute and try to
Right.
lose 20 pounds a week before your physical.
That's it.
Not fun
Right.
for anybody, right? Uh,
Great analogy. Yeah.
so that discipline is critical, and it makes a lot of sense.
Right.
With the years of experience that you've had, you know, in a perfect world, if you were building a modern unclaimed property program from scratch today, how would you leverage technology and data differently than companies did, say, 10 years ago?
Yeah, yeah. Like we had mentioned before, like I said, probably the biggest difference over the years, past 10 years or so, has been, companies shifting from that reactive, filling, the fulfillment of a process or an annual task, into more of a data-driven, continuously monitored program that's now integrated into the company's financial systems. So what we were talking about before is just making sure that companies know that these are things that need to be addressed on a daily basis, because unclaimed property is kind of what I call that net at the end of a period or fiscal year, where now all of a sudden we've got a year's worth of activity or transactions that, oh, maybe they are dormant. And now we're looking at volumes of records as opposed to small incremental records that are more manageable throughout the year. So think about that. Somebody that's responsible for unclaimed property get to the end of a quarter or the end of the year, and now all of a sudden I've got a list of hundreds of checks that need to be researched before we can send out a letter, to notify the owners as part of our due diligence requirements, or, to report it to the state. Well, now I may have to drop my daily task and focus on that for 2 or 3 days. So again, not waiting until all of that accumulates and addressing it as part of your daily routines. And again, using automation and AI to automate some of those functions, right? So again, knowing what, flags, certain checks. I mean, checks are easy, because if the check hasn't cashed within, say, 30, 60, 90 days, or, whatever, is appropriate for, the company, maybe at that point you have AI tools that say, okay, hey, here's our list of checks. Maybe it's a list of 20 checks versus a list of 200 checks at the end of the year. So it just makes it so much easier to address in smaller increments than it is to wait and let it accumulate.
Right. Lot of similar themes going on here. So you
Yeah.
talked a little bit about year end. So before year end close, how should finance leaders be thinking about their own dormant or untracked financial assets, and what role can proactive asset recovery tools play in reducing their future exposure?
Yeah, absolutely. I would say, asset recovery, I kind of look at that from two different perspectives. Asset recovery, obviously starts with what the company itself identifies and reports as unclaimed property. Because again, you want to keep those assets under management. It's, if you truly owe the money to another, business, or to an employee, a vendor, supplier, whatever, then that's what the state unclaimed property laws are there for. That, look, if you can't get the money back to the rightful owner, then the state, law, requires the state or allows the state to accept that money. So asset recovery, from that perspective means, again, what we've talked about is making sure that the company builds those protections in its daily functions, and, from a financial asset management and risk management perspective, to protect those assets. But then on the flip side of that, I look at companies that may have unclaimed property owed to them that yet another business. So in this case, I, the business, could have, a vendor or a supplier or, another business that has reported unclaimed property to the state that was owed to me that I didn't know. Maybe I was written a check, we never received it, or if we did, it didn't get posted or applied properly. So now that other company has reported money to the state that I now can go claim on behalf of my company. So that's, a different approach, right? That's actually going and recovering assets that are already held in a state coffer. And I know that, there's more than just state unclaimed property programs that money may be sitting. It could be sitting with courts and municipalities and, other government agencies. So there's a lot of money out there. We're talking billions of dollars that is claimable, but companies are hesitant to do that because their concern is, well, what if I'm not in compliance myself
Right.
and I go claiming money from the state? Isn't that just going to raise a red flag and trigger an audit? And in some cases, that may be true. But I always say it's your money.
Right.
And I would say use that money to pay for implementing your unclaimed property program, or use that money to offset and pay for the cost of compliance with state unclaimed property yourself. So it really is a twofold facet of looking at asset recovery. But I would say, companies should be proactive in pursuing both.
Right. It makes sense. I like this idea of offsetting. One offsets the other.
Mhm.
That makes a lot of sense. I'm sure you use that a lot in your
Right.
practice. So, of course, in your current practice and with your extensive experience in this sort of niche-ish area, I'm sure that you have had some really, really interesting stories that you've been dying to tell. And would you be willing to tell some? Of course, they shall remain nameless.
Right.
No, to protect the guilty or the innocent. We'd love to
Right.
hear any stories that sort of top of mind from any stage in your career.
Yeah, gosh, I've been doing this for a long time. There's so many stories to tell. I would just say, the ones that are probably the most memorable to me are the big wins or the big savings for my clients. For example, I've seen, in situations where a company thought that they could go at, a voluntary disclosure agreement or an audit on their own, and then ultimately have, the recognition at the end of that going, gosh, we obviously didn't do this right because we're facing a rather large assessment. So, they hire me to come in and, basically use those same records, use the same thing that, the states and the auditors have been provided to quantify what I call as an alternative calculation so that we can debunk, what the state auditors have assessed, or, what has been deemed the potential exposure by the company, which obviously they're not going to voluntarily settle for if they think the number's not right. So I would just say, being able to come in and especially in those situations, show the client that, look, if we had done things differently from the onset, and it starts with scoping, right? Scoping your audit, scoping your VDA properly, you could have saved yourself a lot of time, a lot of heartache, right? So it just, showing them the value that, a seasoned, professional, or the knowledge that, we can bring to these situations, just again, those big wins, because it's calculable. We can show that value in dollar signs, and that sometimes is huge to a company.
Can you,
But
can
I
you
would have to
recall,
say,
Samantha, can you recall any particulars in terms of dollar signs as sort of some of your biggest wins or?
yeah, I can say, there's been quite a few stories that they're along that line, but I would say probably one of my most memorable was in relation to an audit. This was many years ago, back when audits were much more aggressive, much more contentious than they tend to be today, even though they still can be that way. But back in the day, we had our moments. But I remember I was actually working with a retailer, and the auditors had calculated a very large number. Again, these are just numbers I'm going to throw out just for discussion purposes. Nothing non that I can't disclose publicly.
Right.
But basically, the company, let's say, the auditors calculated a $20 million number. And the company's like, there's no way we're not paying $20 million.
Right.
That can't be right. So again, me and my team, we come in, we calculate something more reasonable, and we did. It was somewhere around a million two. We thought that was a reasonable settlement assessment.
Right.
So we meet with the state and their auditors, and in that room, the CFO of the company actually attended because it was his intent to basically negotiate a settlement to that audit right there in the room that day. If we can reach an agreement, we'll consider this done. Well, unfortunately, because the auditors had calculated such an unreasonable, unrealistic number, that the state was kind of put in a position that, they were not even prepared to meet anything and negotiate anything close to $1 million.
Right.
Their number in their minds was, somewhere between 8 and 10 million. That was their number. And I just remember the CFO in that meeting, getting a little frustrated that, we couldn't get closer to that $1 million number. And finally, the CFO just came out and said, if you issue this assessment, you'll bankrupt this company. And, unbeknownst to me and my team at the time, again, was that a negotiating tactic? We didn't know. So, we left the room rather abruptly. No settlement was reached. So a couple of days later, I was actually getting ready to go into the office, and I'm listening to the news, and I hear an announcement that that same company filed for bankruptcy.
Oh, wow.
And I kid you, so even at that point, so no sooner, I didn't even finish getting ready. I was not even in the car heading into the office, and I get a phone call from the state administrator going, "Hey, we're willing to accept that $1 million offer." And
It means
I just
everything.
said, yeah, like, and my response was, and again, trying to be as polite as I could. You did see the news this morning, right? And I knew that he did, because obviously that's why he was calling. And I basically very politely said, it's not $1 million anymore. So we basically settled for much, much less than that $1 million, simply because the company did file for bankruptcy. Now, granted, do I think filing for bankruptcy is the answer to getting out of a large assessment? No, but in that case, that actually worked.
Right.
So
Right.
the company did survive. They did go on, even though they filed for a reorganization. They did go on for quite some time after that. So
That must have been an interesting day. I can imagine it was a very interesting way to start your day. Now,
absolutely.
yeah, Samantha, if you could wave your magic wand and you could have a one wish on what could make your job easier starting tomorrow, what would that wish be?
Oh gosh, that is a loaded question, right? I would just say that, having, the all of the tools and all of the staff in place to handle all of the work that's out there. There are so many companies, Sean, that need help, whether they know it or not. And, as more and more companies are starting to become more aware of their reporting responsibilities, these states are getting far more proactive in audits and inviting companies to participate in their voluntary compliance programs. I mean, we're seeing a lot of opportunity to help companies come along. So I would just say, if I could wave my magic wand, I wish I could replicate, some of the professionals that are really good at what they do, because I just think that there's so few of us, and there's so much opportunity and so much, work out there to be done to help companies get into compliance with these unclaimed property laws. I just wish we could replicate. And then obviously, if AI can kind of help fill some of that void, to be able to build out those tools and make them readily available, not just, for us to, use, within our own capacities, but also to make those available to companies that could certainly see the value and benefit from that.
Well, we hope that at least on the technology AI side, Asset Find can help with that
Yeah,
problem. But it makes a lot of sense.
absolutely.
And Samantha, it's been an absolute pleasure having you today, and we thank you for all your insights. And we thank everybody else for watching, and tune in for our next episode. Thanks very much, everyone.
Yeah. Thanks, Sean. It was a pleasure.